Welcome to it as we talk about a topic that I think is very interesting, especially ever since we learned about the ideas of cryptocurrencies. But in this particular case, we are going to see what is happening in the crypto space and as it relates to SARS. And that's because the South African Revenue Service has joined 48 countries in cracking down on people who are using cryptocurrencies to dodge taxes and launder money. The 48 jurisdictions, including South Africa, they've pledged to adopt a new crypto asset reporting framework developed by the OECD and put it into law. And to give us some perspective on that, but also to talk about how SARS does view crypto assets, we are joined by Jashwin Baijoo, who is the Head of Strategic Engagement and Compliance at Tax Consulting South Africa. Jashwin, thank you so much for your time. Let's start off here with the view of cryptocurrencies by SARS.
Good evening, and thanks for having me. So, as a starting point, there's two classifications, right? Your crypto asset, as it's referred to because SARS do not recognize it as currency per se, is falling into two classifications. One is that it is an asset, and therefore disposal will attract capital gains taxes. And the other is based on frequency of transactions. It falls into the trading stock category, meaning that any revenue derived from the transactions of such cryptocurrency will fall into the typical definition of gross income and therefore be taxed in an individual's case at their marginal rate, and in the case of a company at 27%.
I mean, take me through, over the years, in your experience working in the tax space, how far we've come to get to this point. Because initially when we were talking about cryptocurrencies, the South African Reserve Bank was still trying to figure out how do we deal with these types of currencies. And then, we had to think about it from a tax perspective, the journey for us to get here.
Look, so quite frankly, the South African Reserve Bank is still figuring out how to deal with cryptocurrency. And that I can tell you firsthand. And the reason for that is, aside from Tax Consulting South Africa, I do head up another business within the same group called Crypto Tax Consulting. What we do is we specialize, one, in your crypto tax computations, two, in crypto legal advisory, including the apportionment of capital versus revenue, the classification of crypto disposal, and thirdly, with actually engaging to authorized dealers with the SARB in terms of getting specific trading models approved. Now, what the SARB has provided as more informal guidance is when there is a trading model, you've got your standard trading model, you've got your advanced trading model. And this pertains to something like crypto arbitrage trading, where a resident is involved and utilizes their 1 million rand single discretionary allowance, or alternatively, in the current era, makes use of the approval international transfer to move a larger amount of funds over and above the 1 million. SARB's very not solid guidelines are that, one, there must not be an externalization of value from the South African base, and two, where there is any externalization, it must be returned to South Africa within a reasonable time period. So the SARB does have a crypto regulatory framework or working group that is developing standards by which they can regulate not just crypto trading, but also crypto holding, staking. There's a whole plethora of different activities that have evolved in the last about 5 years or so in the crypto space. But currently there is no concrete guidance. And that is what actually leads us to South Africa signing into the CARF.
Yeah.
Very simply, CARF is catering for the automatic exchange of information. And as we've seen from SARS, they're all about automatic exchange of information with different jurisdictions, and with their AI upgrades and modernization of SARS methodology and technologies, making it easier for this free flow of information. So yes, on a general standpoint, that automatic exchange of information is in place for SARS with about 150 odd other jurisdictions.
Yeah.
However, now expanding that scope to cryptocurrency and crypto trading speaks volumes as to the modernization of SARS and keeping up with the new digital age. This would entail that SARS would have access not just to other jurisdictions and financial institutions in those jurisdictions, but also crypto trading platforms, which taxpayers previously thought were outside of SARS's purview, whether it was local or international, such as the Binance on an international scale and perhaps the Luno on a local scale.
That's quite interesting. So what's the deadline here? Because, I mean, this was signed off in March of this year. And as I mentioned in my intro, you have these 48 countries adopting the standard. What's the deadline for, I suppose the standard to be implemented into their laws?
Look, so like most things, it is a case of signatory states. Signatory states must then take the international, in this case the OECD principle, and have a localized version, which is subsequently tabled and white paper, green paper, etc., and eventually gets promulgated into law. So I would not say it's a hard and fast deadline. It is something to provide a bit more concrete guidance and a bit of a framework for SARS and SARB to consider when building their own localized frameworks. But the actual adoption in terms of regulation, this is for the sharing of information, automatic exchange of information on a global scale. So whether we will see it written specifically into law or whether it will become best practice is really a question that only time will answer.
The topic of tax always comes with its own questions and confusions and things that people don't understand. But then you throw in cryptocurrencies in the space and the waters get a bit muddy and people get a bit, nervous or they don't really know what to do. In your experience and some of the, inquiries that come through or some of the things you may have to deal and help clients with, what are some of the common issues you encounter as it relates to cryptocurrencies and tax?
Well, the common misconception is that any crypto asset transactions are non-taxable. That is entirely false. They are fully taxable. And what decides how it's taxed is actually your nature of transaction. So in a hypothetical scenario, if you were to acquire a crypto asset, let's say you acquired one Bitcoin in 2017. And we know back then the crypto markets were profitable. It was a massive boom. So you acquired it back then, you held on to it, and you disposed of it now, tomorrow. Based on the fact that you've held on to it for that extended time period, more than about 3 years, and your intention was never to transact, but rather to hold on to it for valuation purposes, that would be construed as capital in nature, the disposal of an asset and attract capital gains tax. Now, the converse situation is if you acquired one Bitcoin and then a month later sold 10% of that Bitcoin, then you acquired another 20% of another Bitcoin, and then you basically have this pattern where you transacted very frequently. That would then be deemed as trading stock, meaning you would be taxed at your marginal rate per the tax tables. One very, very important point that taxpayers need to be aware of is any crypto disposal, whether it is an on-platform disposal, meaning you sell your one Bitcoin, you do not extract the funds, they stay on platform in your wallet, or you move the Bitcoin into a cold wallet, are all taxable events, which means they attract tax by the very nature of being a disposal. The same can be said where a crypto asset is realized and is then converted to fiat currency and withdrawn from your platform wallet in your bank account, as well as where you transact crypto for crypto. They're all taxable events.
Wow, that is fascinating. We've got about a couple of minutes left in the show, and I would have loved to talk to you in greater detail about this idea of how crypto traders may be accumulating debt without even knowing. And I found that to be quite fascinating. But in our discussion around SARS and the crypto crackdown, if we want to call it that, if listeners tonight remember nothing else about, tax implications surrounding crypto, what is the one thing you want them to remember?
Look, so with the cryptocurrency specifically, and then tax debt generally, where taxpayers are unable to afford settlement of that debt, and especially in the case of crypto, because of market volatility, your transactions, as I said, every trade is a taxable event. But the devaluation of your assets may have now put you in a position where you genuinely cannot afford that. There are debt relief mechanisms available to taxpayers on crypto debts, on general debts, companies and individuals, that's PAYE income tax, where they genuinely cannot afford to settle that debt,
Right.
and they are allowed to then enter into negotiations with SARS for either a deferral of payment, which is basically a monthly where you genuinely cannot afford that. There are debt relief mechanisms available to taxpayers on crypto debts, on general debts, companies and individuals, that's PAYE income tax, where they genuinely cannot afford to settle that debt,
Right.
and they are allowed to then enter into negotiations with SARS for either a deferral of payment, which is basically a monthly payment plan of your entire debt, including interest and penalties.
Yeah.
Alternatively, a compromise of tax debt, which is the most favorable to the taxpayer on one side and favorable to SARS, as in line with the tenets of good taxation. Using
Jashwin,
this avenue,
unfortunately,
they will
we
write off the
are
question.
running out of time, but we'll definitely continue this conversation on another day. That was the voice of Jashwin Baijoo, who is the head of strategic engagement and compliance at Tax Consulting South Africa.